What we can see, though, is still inflation's accelerated. It went from 3.2% in the last month and 3.8% in October. That doesn't mean the acceleration is real because we don't really know what it would have been at this index going backwards. So us, the RBA and everybody should take these numbers with a grain of salt and wait for a few more releases to see what the momentum in inflation is. The other interesting thing is the main component of inflation in this release has been the housing component, and that was largely expected. It went up by 5.9% in the year. And most of the drivers of these are related to electricity rebates being removed. Electricity costs went up by about 30%, 37% in the year to date. So it's a really, really hard to see underlying pressures in this release. They did provide a monthly underlying trim mean measure, as they call it, which went up to 3.3 from 3.2. So all of it, what it says is there's a little bit of momentum in those components that are related to the housing sector and services in general. So rent went up slightly. We have new dwellings, as in the cost of constructing a home went up, and we also had the issue with the electricity. So I guess we'll need to digest the data and get a few more releases before we can see where the inflation number lands.
Yeah, so the Reserve Bank has really wanted this updated monthly series so that the monthly data is more comprehensive than it typically has been. And of course, the monthly series is quite new, but this is the first month of this comprehensive data. How long do you think it will take for the Reserve Bank to really rely on this? Is it going to be looking at the quarterly data for some time?
Yeah, so as soon as this data is released, it will become the target for inflation. So they will start looking at monthly inflation to set the cash rate. This is consistent with G20s and best practice for all advanced economies. I think New Zealand will be the only one left with no monthly inflation now within that group. But they did clarify that they're going to look at what the seasonal adjustments were, and they will need a few months to see that. So the month-on-month measures are not really that important just yet. So they will need at least 3 months of those to see the year-ended inflation on that month. And also their forecast will remain on a quarterly basis. So they will use the average of those 3 monthly prints to see where the average inflation was at the end of the quarter.
So when do we get the next quarterly read, and is that going to be much more key for the Reserve Bank as this series sort of starts to settle down?
Yeah, so before we get the monthly inflation data, we do get more important ones in terms of price pressure, which come with GDP release next week. That will be all available before the next RBA meeting. So they will get the GDP deflator that shows domestic price pressures across the economy. And most importantly as well, the labor cost component, which is running at 5%. So they were really keen to see if that's easing, and that will eventually fit to inflation as well, because that's what the real price of things in that we pay for in the economy. So I think before we get the new monthly one, they will pay more attention into the GDP data next week.
Yeah, of course. And I mean, as we head into Christmas, it hasn't been looking very like we will get an interest rate cut from the Reserve Bank. Heading into this monthly inflation number, the Reserve Bank, markets were pricing in the Reserve Bank chance of an interest rate cut at about 7%. As I look at that screen now, the probability for a cut has now diminished to about 5%. So, I mean, at the margin, has this further removed chances of a rate cut this year?
Yeah, I think what happened was the RBA is very happy to sit and wait for how the data evolve. And this is due to 2 reasons. The first one is inflation is changing the way we measure it, and the previous underlying measure is not going to be consistent with the one we just got now. So they need to look through a few releases, so they won't know exactly what to do, and they better off waiting to see. It's better off not cutting too early than cutting a little bit late if they need to. But in saying that, we have been making the point that the labor market is slowing, employment has been slowing. So between these two, they really need to strike a very difficult balance. So employment data will not be available before they meet in December. So with no much information data-wise, it's very likely that they will stay on hold and wait until the February meeting. We do think rates are likely next year, but we don't know exactly the timing considering the changes in the data.
Yeah, that's right. And as you say, they don't meet again after December until February. So is it likely that they will have to wait and see what next year's data prints hold before they make a decision? Are you thinking that if we do see cuts, they will come midway through the year, or it's just a bit data dependent, as the Reserve Bank itself has been saying?
Yeah, I think at this point in the cycle where we're getting close to what we call the neutral rate, where the economy is not expansionary or, being pushed down by high rates, as they get close to that number, they'll get more hesitant on their decisions and they go on a date or meeting by meeting date and regarding the data that's coming through. Another important thing ahead of their February meeting is that they will have a new round of forecasts, and they've been quite clear that they do make the decisions on the back of this forecast. So the forecast for November showed that inflation is likely to stay above their target for the rest of the next year and a little bit into 2027. So if we see disappointments on inflation numbers, on growth numbers, and their forecast needs to be downgraded, there might be a risk that they cut in February as well, but it all depends on what the labour market's doing as well.
Do you have a forecast for the terminal rate where interest rates will end up?
Yeah, so we think it's going to be around the 3.1%, which means one more cut. But if the labour market continues to behave this way, we think the risk is for a lower number.
Michaela Ficilla, thank you so much for taking us through that. Much appreciated.